Okay, in the interest of time, we will go ahead and get started. Good morning, everyone. I'm Jennifer Slattery, Director of Membership and Training at the Rhode Island League of Cities and Towns. Thank you for joining us with another Workshop Wednesday. I do want to just take a moment to acknowledge this solemn day in American history and honor those, especially those in public service, who answered the call on September 11th, 2001. So we could just pause for a moment. Thank you. So today we have a presentation from our colleagues at the Rhode Island Public Expenditure Council. Dr. Justine Oliva is RIPEC's Manager of Research, and she will be discussing their June report on shifting burdens in Rhode Island's property tax system. So I will turn it over to you, Justine. Thank you so much for being here.
So much for having us. I'm going to share screen now. You'll let me know if I'm doing so incorrectly. We're open?
Looks great.
Great. So thank you for the introduction. For folks that might not be familiar, I thought I would start by just giving a brief overview of Rhode Island Public Expenditure Council, commonly known as RIPEC. So we are a 501c3 nonprofit, nonpartisan public policy research organization with roots all the way back to the 1930s. Our mission is to promote responsible public policy and to enhance economic opportunity for people in Rhode Island. We conduct a lot of research around topics including state finance, tax policy, K-12 education, and then another large focus of RIPEC is municipal finance. Over the last few years, we've published a series of reports on municipal finance, an intro to municipal finance, an intro to the property tax system in Rhode Island, first in 2022, and then education, finance, and municipal spending reports. We hope to serve as a resource for folks in city government and in town government, and hope to continue to do so with this presentation after. So, I ask folks, please feel free to ask questions here, and please also feel free to reach out after this presentation. We're happy to serve as a resource and continue to have conversations around this topic and topics of municipal finance more generally. So the presentation today is from a report first released in June, and it's an update of a report from 2022. I'm going to present on first kind of a background of how property tax systems function in Rhode Island and a few recent policy changes at the state level. I then am going to give an overview of property tax reliance in the Ocean State and compare it to property tax reliance in other places to get a sense of how much it matters to local government in Rhode Island compared to other places. The next section of the report, A System Out of Balance, I think really gets at the crux of the report. It was the name of our initial 2022 report. And it describes the way that there's a lack of balance between cities and towns in terms of their available property tax resources and the structure of the property tax systems, and then how this lack of balance then extends to taxpayers, in which certain taxpayers are picking up much larger pieces of the property tax burden than others. The next section of this report goes into property taxation trends, so I'll give a brief overview of really what's changed in the last 2 years. The title of this presentation, Shifting Burdens, gets at the fact that while we pointed to a system being out of balance in 2022, what we've seen in the last 2 years with a real large rise in real estate values, and particularly residential real estate values, is that this shifting of the property tax burden from some taxpayers to the others has grown overall statewide. And then finally, we'll get at our comments, kind of an overview of the presentation and some recommendations that RIPEC has put out for policymakers. So the first thing about Rhode Island property tax is that it's incredibly crucial, not only to local finances, but to state finances. So in total in FY 2021, 2.7 billion in revenues came from property taxes statewide. That, as you can see, is 40% of state and local tax revenue combined. When you're talking about just municipally generated revenue, locally generated revenue. It's much bigger. It's almost 90% of all locally generated dollars. And I think another kind of important point here is this 2.7 billion in revenues when we're talking about state and local finances is much larger than the largest forms of revenue taken in at the state level. So the individual income tax is the largest state revenue source, and it is significantly smaller in terms of total revenue. I think 1.8 billion compared to the 2.7 billion brought in for property taxes. So one of our contentions is that Rhode Island property tax is something that requires a lot more attention than it currently receives because it's administered at the local level. Sometimes there's less analysis or discussion around property taxes and perhaps statewide taxes like the income tax or sales tax, which are ultimately smaller in terms of revenue generation. Rhode Island cities and towns overall have pretty broad flexibility in setting property tax policy, but they derive the power to levy that from the General Assembly. And the General Assembly has dictated some features of property tax system that you all abide by. So first, that there is an annual 4% levy cap. And then secondly, there are certain features of assessment systems that must be in place. So for real property real assessment has to happen every 9 years, and then every 3 and 6 years, there have to be statistical updates. For all but one community, property is to be assessed at a fair market value. There is a statewide classification plan. Generally, property is split in most communities between these 3 classes. So residential real estate, which includes all residential real estate under 6 units. The class 2 commercial property includes mixed use real estate, and it also includes residential real estate of greater than 6 units. And then class 3 is tangible property. The state classification plan, in addition to defining types of property, sets limits on the extent to which cities and towns can apply different effective rates to one class of property in comparison to another. They may not tax one class at more than 50% the effective tax rate of another. However, our research has shown that most cities and towns have some sort of classification statute exemption, either their own statute or an exception into the state plan, so that functionally the state classification plan does not apply to a majority of communities. Firstly, there are a number of communities that tax all types of property, all classes of property at the same level. And then secondly, there are a number of communities that may tax one class of property at a level that is far higher or far lower than another class of property. Additionally, the state classification plan differences might be around how certain types of property are classed. So as I said, residential real estate in the state plan is under 6 units. However, it might be a lower level in some communities. So for instance, Newport has a lower threshold for what is residential property, and it classes things at commercial property at a lower level. In addition, you have, I think, some outliers in terms of property tax classification, one of which would be the city of West Warwick, which has a separate class for residential real estate in more than 6 units and has a number of other distinct pieces to it. I point this out in part because in 2024, Providence received statutory authority to create a separate class for apartment units for apartments with more than 6 units. And it's something that we at RIPEC have done some investigation on, and I'll talk about this kind of more later in the deck. But essentially, the idea behind a classification plan like this is that it enables a city to tax apartment property at a higher rate than it taxes residential real estate of either fewer units or single home units. And it also allows it to tax it at a lower rate than commercial property. Because when apartments are taxed at the same rate as commercial property, particularly in this period in which residential property has increased in value at a high rate, it might lead to particularly high property taxes for such apartments. That's depicted in the figure to the right, which shows the change in average assessed value versus the change in property tax levy in the city of Providence between 2018 and 2023. So as you can see, both apartment buildings and single family units on average saw their assessed value increase by quite a lot. by 75% for single families, and by 63% for apartment buildings. But their average tax bill changed in very different ways. So the single family home actually saw a slight decrease in their tax bill over this period of time, amounting to around $20, under $4,000 is the average amount. And the apartment buildings, on the other hand, saw an increase in their property tax bill of 56%, and it amounted to around $20,000 increase because it is taxed under commercial property. So the idea of a classification plan like this is that it kind of separates out that apartment property from other commercial property. The tangible tax, importantly, is assessed differently than the real property. So it's assessed annually through a self-reporting process. The figure on the right depicts the depreciation schedule that is used for tangible property. Taxpayers are set to determine. Taxpayers are set to determine, the original purchase price of property, whether it is a short life, midlife, or a long life piece of property, and then to depreciate it based on the age of said property. So there's a certain level of complexity here to accurate reporting of tangible tax. In some cases, we are aware that there are relatively high rates of non-reporting, in which case we know cities and towns will do their best to get an accurate reporting of what they think that amount is. But overall, there seems to be a little bit of variety in terms of the practices used by cities and towns to ensure that they get accurate reporting, of the ability of cities and towns to ensure accurate reporting, and a relatively large burden on taxpayers paying the tangible tax relative to real estate, in which the taxpayer receives an estimate of what their assessed value is rather than supplies one. There are a few important exceptions to tangible tax. Manufacturing equipment has been exempt since 1975. Inventory has been exempt since 2010. And beginning in FY 2025, there's an exemption on property valued at under $50,000. The exemption law also capped rates at their FY 2024 level. The state is to reimburse cities and towns for their FY 2025 levy loss attributable to exemption. I know that there was issue with the reimbursement over the last year that has since kind of been rectified. So now the loss is tied not to the change in levy, devoid of its attribution to this new exemption, but is specifically tied to the exemption. On the reimbursement level for cities and towns and fire districts, both was set at $28 million when it was first funded in the FY 2024 budget. Statewide, we have previously estimated that 75% of all payers would be exempt under the new exemption, but the extent to which this is true is going to depend quite a bit on cities and towns. They have different structures of folks that pay their tangible tax. Cities receive payment for property outside of standard property tax. One way they do so is through pilot programs. So there's the state pilot program, which reimburses up to 27% of revenue that could be generated if certain types of property were not exempt. So not all tax exempt properties, but nonprofit education institutions, private and state hospitals, correctional facilities, and veterans and residential facilities only. It is funded up to 27%, but as I said, it could be less. And this year, there was no increase in the amount year over year. And so it is funded at 26.7% at $49.2 million. The figure to the right shows that distribution in FY 2024, and it's really the same distribution as far as I'm aware in FY 2025, with Providence receiving the vast majority of those funds, followed by Cranston, Newport, Warwick, Bristol, Smithfield, and then the remaining communities that receive funds are in the note below, and they all receive under $1 million, and in most cases, far, far less than that. Cities and towns also make pilot agreements with tax-exempt institutions, and this may ultimately form a decent portion of their budget. So if you take the pilot aid that Providence receives from the state, in addition to their private pilot agreements with nonprofit institutions and with other institutions, it ultimately makes up around 8-9% of their budget, for instance. Cities and towns are authorized to provide various forms of tax relief for certain residential property owners. This includes homestead exemptions, which I'll talk about a little bit later in this presentation. But tax relief might include assessed value exemptions, flat tax credits, deferrals, and tax freezes. And the property owners that may receive it, in addition to residential property owners, which I've said we'll discuss later in the presentation, might include individuals who are elderly, disabled, visually impaired, or veterans. RIPEC's review of the Division of Municipal Finance's data on this, that I think is most recently from FY 2023, showed that every community had some sort of flat tax credit or personal exemption for individuals who are elderly, disabled, or elderly, visually impaired, or veterans. And then a few also had exemptions for disabled individuals, and an even smaller amount had exemptions for folks that are low income, regardless of whether they fit these other categories. In most cities and towns, these exemptions were relatively minimal, and there was quite a bit of variety in cities and towns in terms of who exactly applied and who exactly is eligible to receive exemptions. And this is particularly the case for seniors exemptions. So in 11 cities and towns, seniors exemptions apply to all seniors. And then in other cities and towns, there's kind of a variety in terms of what seniors are eligible or what amount they're eligible for. So some cities and towns, seniors are only eligible if they meet a means tested lower income threshold. In other cities and towns, there are multiple levels of tax credit or exemption that a senior could receive, depending on what income limit they reach. Notably, these senior exemptions might impact a really decent portion of homeowners statewide. Around a little less than 1 in 3 homeowners is over 65. Other features important to know is that state law authorizes cities and towns to adopt TSAs of terms of no more than 20 years to promote economic development. These go to certain businesses will make agreements with cities and towns, and what that looks like may vary across the state. And then the motor vehicle tax has been fully phased out. The state reimburses cities and towns for that lost revenue. And in the FY 2025 budget, the total amount for that reimbursement was $234.7 million. So this figure depicts municipal revenue reliance in Rhode Island. It's important to point out that in this figure, which has FY 2022 data from the Municipal Transparency Portal, because that was the most recent data available to us, what RIPEC has done is it has included aid to school districts in the pie with all other municipal revenues. So when you are doing budgeting, we are aware that there is a school department budget that sits separately, and that money that flows from the state and federal and from the federal government to that school department doesn't come through your door. At the same time, given that education expenditures are the largest expenditure of cities and towns, and that it all is wrapped up together in municipal finance, RIPEC has included that as part of the pie here, and it makes up a really large portion of it. So property tax is by far the largest form of municipal revenue. As I stated, if you are only talking about municipally generated revenue and not aid from other places, municipal revenue from property taxes is almost 90%. When we factor in that aid, including education aid, it still makes up over half of all revenue, so 56%. State, federal, and other education aid makes up by far the largest portion after property tax, so over a quarter of all revenues. And then state aid, not for education, ranks third at 7%. So when we're talking about, once again, just locally generated revenues, very little that does not come from property tax. I will also note that there has been a slight decrease in the amount of municipal revenue generated from property taxes in Rhode Island in the last few years. In part, this is due to the final phase out of the motor vehicle tax, but it's also is due to state and more so federal increases in education aid, ESSER aid to cities and towns. And so we expect that the reliance on property tax will increase a little bit as that aid has now run out. So while overall in the state, there's this 56% reliance on property tax that varies quite a bit across cities and towns. So as you can see here, a number of cities and towns, I'll back up a second, I apologize. So what this figure shows is this pie for Rhode Island. Now this is the pie for the cities and towns that have the top 5 and bottom 5 reliance on property tax revenues to fund their city, town government, as well as their schools. So there are communities in which property tax revenue make up 4/5 of all revenues, and there are communities in which property tax revenues make up less than half. So as you can see, the 4 cities of Pawtucket, Providence, Woonsocket, and Seneca Falls all rely more on state, federal, and other education aid than on property tax revenues. So a lot of variety across the state. So research has shown that property tax reliance is a primary cause of inequitable school funding nationwide. And for this reason, we'd like to highlight here that property tax in K-12 funding context. So as this figure shows, Rhode Island has more reliance on local revenues and less reliance on state revenues to fund public schools than is the case in the United States overall. However, Rhode Island has grown more in line with the US overall in the last decade or so since the introduction of the school funding formula. It's the beginning of its implementation in FY 2025 or FY 2012. Rhode Island has moved about 5 percentage points, which is a really large amount in terms of its state share and its local share. So, increasing the state proportion and decreasing the local proportion. At the same time, given that Rhode Island is still out of step with the US average, the lack of, given that Rhode Island is still out of step with the US average, there's reason to be concerned about the ability to provide equity within our school systems. Compared to other states overall in the United States, Rhode Island brings in a lot in property tax revenue. So the figure to the right shows property tax collections per capita for the New England states and also the United States median for FY 2022. The state of Rhode Island, as you can see, brought in a lot more per capita than is the case in the United States. However, that is lower than in the remaining states in New England. New England is relatively unique in its reliance on property tax revenues. The other states that are kind of up there with New England are New Jersey and New York. So there is kind of a northeast reliance on property tax revenue, of which Rhode Island is a part of. However, as far as the US goes, this is not the case. It's important to point out, though, that when we're talking about how property taxes compare, it's somewhat misleading to compare one state to the other because it very much is a locally administered tax. And so even though the state of Rhode Island brings in less per capita than Massachusetts, that doesn't necessarily mean that taxpayers in Rhode Island are facing lower property tax burdens than is the case in Massachusetts. It really depends on what type of taxpayer you are and where you live. So in evidence of that, the Lincoln Institute of Land Policy does an annual study of property taxes across the country, in which instead of looking at states, it looks at the largest city in each state, in addition to a few other cities, and in addition to rural municipalities, in order to gauge what property tax systems look like across the country. And their annual survey, the most recent version, found that Providence had the 3rd highest effective commercial tax rate in the nation, after only Chicago and Detroit, and much higher than in neighboring New England states, with the exception of Connecticut, which I believe also had a very high commercial tax rate. Providence also ranked 19th highest for its apartment rate, but then on the other side of the coin, ranked 42nd highest for its homestead rate. So the large difference between the commercial taxpayer in Providence and the homestead taxpayer in Providence is something that this study noted. So as I noted at the beginning of this presentation, the system is out of balance as far as we see it. It's out of balance for cities and towns and also for taxpayers. So this, may be the most important figure in the report as far as we're concerned. It's gross assessed value per capita for fiscal year 2022, which is the most recent year for which we have the available data. So what this shows is only property exempt by the state and federal government is excluded here. So it's all the property that cities and towns have the ability to tax, and it is divided by the number of permanent residents. Of course, per capita is not a measure without some complications. So it doesn't count non-permanent residents. It doesn't necessarily depict community need, but it is a relatively fair means of showing how some cities and towns have much greater ability than others to generate adequate revenue for the folks that live there. So this figure shows those communities with the 5 highest and 5 lowest gross assessed values per capita in FY 2022, as well as the Rhode Island state total. So in total, there was $163,000 per person in property value on which tax to generate property tax revenue. But we had around 9 cities and towns had over $250,000 per capita. Some cities and towns had far more. Shoreham is excluded in a footnote here because they ruin the scale of the figure. And then we have some cities and towns that have very, very little to work with. So under $100,000 per person in property value for Providence, Pawtucket, Woonsocket, and Central Falls. Central Falls on the particularly low levels of property value. So they are under half the level of the next lowest, Woonsocket, at $38,000 of gross assessed value per capita. So there is, as this evidence this shows, there's a very large difference in terms of property value that cities and towns have. Cities and towns have in terms of their ability to tax and to provide services, including education for residents. I'm going to pause a moment on this slide because it depicts tax roll year 2023 or FY 2024. So in developing this report, RIPEC used the most recent available data as provided by the Division of Municipal Finance. We are aware that since we that you all have passed new budgets at this point, that you are working with new tax rates, that you are working with new assessed values and levies that are updated from what we have here. However, this is the most recent available comparative data, and the main crux of the report shows trends over a longer period of time. And so while we will have a new statewide effective tax rate based on all of your new tax rates from this year to reflect FY 2025. This generally shows kind of the trends over the last few years. So just noting, we know that there are more recent budgets that you are working with. What this figure shows is the statewide effective tax rate. So it's calculated by dividing the total municipal levy for each class of property by the total assessed value, and then divided by 1,000. And it's once again reflective of the state overall. So, communities that have a larger amount of property or larger levies, their tax systems, are represented more than some smaller communities in this figure. The figure shows that overall, statewide, commercial property is taxed at a much higher rate than residential property, and tangible property is taxed at a much higher rate than commercial property. So commercial property is taxed at a rate that is 1.7 times higher than residential, and tangible is taxed at a rate that is 2.7 times higher than residential. This shows the wide variety between cities and towns. We cannot fit it on one slide, so I have it across 3, which I can flip through real quickly. But what the color on the right shows, and once again, I understand that you've passed new tax rates since this that you have pass-through tax rates, so this is reflective of a year old, is the range in tax rates across cities and towns and also across classes of property. So the darker the color, the higher the tax rate. So 12 cities and towns in FY 2024 had used the same rate across all classes of property. I believe that this probably lowered, given that there is now a cap on the tangible rate increase. It also shows the difference between rates for the same class of property across cities and towns. So residential property is taxed at under $10 per 1,000 in 6 municipalities and over $20 per 1,000 in 4 municipalities. Commercial property, there's even a bigger spread. So it's under $10 per 1,000 in 5 and over 30 in Providence and West Warwick. And then tangible, an even bigger spread. So under $10 per 1,000 in 4 municipalities and over 50 per 1,000 in 6 municipalities. We can also see here the difference across classes of property reflected in this figure. As they exist kind of in specific cities and towns, they are much greater. So for instance, you can see, East Providence, the difference between their residential rate and their homestead rate is much greater than is the case for the statewide total. The cities and towns that use homestead rate are included here. It includes the communities with a separate tax rate and a flat tax credit or assessed value exemption. I apologize. So Central Falls tax credit is not included in this in these rates, but otherwise assessed value exemptions or different rates were depicted here. You can see once again just this wide variance across taxpayers and also across communities in these figures. This slide shows how those differences affect different types or one type of taxpayer. So it is the resident homeowner tax burden for a home valued at $425,000. It factors in tax rate. It also factors in things like homestead exemptions and fire district tax in communities where that's relevant. We chose $425,000 because that was the average price of a home sold in Rhode Island in 2023. It shows, this figure shows that overall for a home valued at $425,000 in Rhode Island, there was a median tax bill of about $5,800, but that it ranges by about $7,000 across communities. Those communities that have the 5 highest residential property tax burdens includes really a mix of communities in terms of the property wealth available to them. So some of these communities have relatively high levels of property wealth and some have relatively low. I would note that 2 of the top communities, East Greenwich and Barrington, have relatively high levels of property wealth, but they also have very large proportions of K-12 students on a per capita basis. I believe Barrington is at nearly 20%, and East Greenwich is about 17 or 16% of their population is represented by a school-age child. So cost is part of that. But then when we look at all of these bottom 5 communities, the communities that pay the least in terms of property taxes per assessed value, we have communities that are all relatively property wealthy. So Narragansett, Jamestown, Charlestown, Little Compton, and New Shoreham. This figure depicts the difference between a tax burden for a resident and non-resident homeowner in communities that have a homestead exemption in place. So that, as you can see here, in some cases, homestead exemptions are relatively small and maybe worth only a few $100s. So somewhere like Narragansett, Middletown, or Kingstown, there's not a huge difference there. However, there are other communities, primarily urban core communities, in which there is a huge tax bill difference based on homestead exemptions. Nowhere is this greater than Providence, although Central Falls is not very far behind. As you can see here, there's a difference of on a home that was worth $425,000 of over $40,000 in terms of a tax bill that would go to someone. It's also notable that these communities that have really high tax burdens for non-resident homeowners compared to resident homeowners, also have some of the highest proportions of renters. So for instance, Central Falls, Woonsocket, Providence, which all have relatively large differences in tax burdens, rank 1 through 3rd highest in the proportion of renters in the state, from 60% of households in Providence to nearly 3/4 in Central Falls. This figure kind of extends this idea. So resident homeowners and non-resident homeowners are paying very different tax burdens in places that have homestead exemptions. And they are paying very different tax burdens. Sorry, resident homeowners and non-resident homeowners are paying very different tax burdens in places that have homestead exemptions. The people that are often hit with this in renter communities particularly, rather than communities that we think of as more second home communities, are not just landlords, but rentals, because property taxes factor into rental market prices. This is of even more concern if a community has both a homestead exemption or a very high commercial tax rate relative to its residential tax rate. So we've highlighted Providence here as one community in which this is the case, but it's not the only community in which this is the case. It's just the example in which the difference is most drastic. So a apartment property in Providence, if it was a 5-unit apartment property owned by a resident, the tax bill for FY 2024 for $1 million property would be about $10,000. If it was a 5-unit, also worth $1 million, but is owned by a non-resident, the tax bill would be about $18,000. And then if that same $1 million unit, $1 million building was 6 units, it would be classified as commercial property, and the tax bill would be $5,000. So you can see here how different properties of the same value might be taxed at very different levels based on units and based on whether or not there is a homeowner or not a homeowner. Ultimately, what this does then is it taxes higher unit properties and provides higher tax levels for kind of multi-unit renter properties. This figure depicts the business property tax burden for 1 million in real estate and 200,000 in tangible property. The amount chosen for this tax burden comes from the Lincoln Institute of Land Studies business tax burden study. It does not represent a particularly large business, 1 million in real estate and 200K in tangible property. You can see here that the range for businesses is much bigger than the difference between homeowners, and that it is very high in some places. So over $40,000 for a property of that value for Providence, West Warwick, Johnston, and Pawtucket, and then under $10,000 for Jamestown, Charleston, Little Compton, and New Shoreham. Statewide, the median is $25,000. In dissimilarity to the average tax burden for the resident homeowner, what's notable here is that all the communities with the highest tax burden are those that are relatively property poor. And then all of those communities that have the lowest tax burden, in similarity to the homeowner tax burden figure, all of these communities are relatively property wealthy on a per capita basis. So all of this was true when we came and spoke to this same group 2 years ago with our original property tax report. However, in the last 2 years, we have noticed some trends that we'd like to highlight. So firstly, a massive rise in assessed property value, and particularly in residential property value. So commercial, tangible, and residential property have all increased in value in the last few years, and particularly in the last 2 years, but residential property has particularly increased in value. All classes of property combined have increased by 25 billion in just between FY22 and FY24. And the increase has, the 2-year increase is actually 28 billion, and 25 billion of that is just residential property in the last 2 years. So this is real wealth generation for property owners, and it is, a good thing, right? This is actual. These are actual assets that folks have that they did not have before, with the higher property values for individuals, but ultimately, if tax rates were kept the same, it would have meant a larger increase for residential property, because residential property is now valued at an even larger amount. Many, I think, cities and towns did not want to see an increase in residential property taxes. And so more of the tax burden got shifted onto commercial property and tangible property. To be clear, what this shows is the percent difference in effective tax rate by class of property statewide between taxable years 2014 and 2023. And what you can see is that the difference between the rates applied to commercial versus residential property and the difference between the rates applied to tangible versus residential property grew quite a bit in just the last 2 years here, between FY22 and FY24. And it corresponds with this kind of massive increase in residential property value and in total property value. To be clear, this doesn't mean that tax rates went up for commercial property or tangible property. Tax rates went down for all forms of property because the value went up to such a high level. However, the extent to which rates went down for commercial did not nearly compare to the extent they went down for residential. So the effective tax rate statewide for residential fell by 13.9%. Between FY22 and 24, and that's compared to a 6.1% decrease for commercial and a 1.2% decrease for tangible. For some communities, there was no change, importantly, in this time, and for some communities, the change was much greater. So, for instance, Johnston decreased their residential rate by 34% in this period, while decreasing their commercial rate by 3.2% and slightly increasing their tangible rate. So the extent to how this looks across the state differs quite a bit. But overall, what we've seen is kind of an increase in the shifting of burdens. Another important thing to note is the property tax cap and inflation. So the property tax cap of 4%, communities have largely stayed well under that historically. What this figure shows is that between FY 2016 and FY 2019, levy increased average on an annual basis by 2.3%. In the period from FY20 to FY23, the levy increase was an average of 2.5% annually. Now, while levy increases were running slightly ahead of inflation, for this later period, they were running slightly behind inflation. Some cities and towns have accidentally exceeded levy limits in the last few years. And I think also noteworthy is that there's some question as to if everyone is counting the same way. So there's a question as to whether revenue derived from property like TSA payments or pilot revenue should be included in year-over-year levy increases or not. The law appears to be relatively ambiguous as far as that goes. I see that I've somehow managed to talk for 45 minutes already, so I'm going to try to go more quickly through these last few slides so that we have time for questions, comments. Just noteworthy as part of this discussion about property tax revenue recent trends that are things that we should think about going forward is that Rhode Island has relatively low per pupil expenditures for Rhode Island's poorest districts. It is the third biggest gap in funding for high and low income schools of US states, according to one recent study. That the funding formula increased the percentage of state aid for poorer districts, but it did so only slightly, and that we've seen a reverse of this trend in recent years. And that many local governments have not kept pace with increases. The maintenance of effort law does not require funding increases of local governments, and as the state has kicked in more over time, some local governments have not. And there are funding challenges ahead as far as K-12 goes that are going to implicate property tax systems. So one is that districts have experienced enrollment declines, and they have received state aid that does not necessarily reflect those enrollment declines over the past several years. There's been kind of broad-based, what we call the whole harmless funding, in which school districts were receiving up to this year 20% of lost revenue for students that may have left prior to the pandemic. That is being moved away from. There's still an enrollment loss transition fund, but it will be used off actual enrollment levels. And so there may be a hit to some districts based on that. Also, all federal ESSER aid must be expended this month. And so ESSER aid is no longer in the picture for districts, creating greater challenges. and that there's a large projected state deficit for FY26, which may create challenges in terms of state funding that would be available to property tax systems. Overall, for us, the takeaways are that, firstly, cities and towns hardly resemble each other in terms of their property wealth, and that limits the ability of some to provide services like K-12 in an adequate way without significant state resources, and some, including us, may argue more state resources. Taxpayers across and within communities are subject to wide variations in tax burdens, and that this disparity has grown in recent years, particularly in the last 3 years. So once again, taxpayers, a homeowner in Providence and a resident homeowner in Providence, a non-resident homeowner in Providence, a person who lives in an apartment in Providence, a business, they pay very different tax rates, and so do folks across communities. And that level of difference, particularly when we're talking about types of taxpayer, has grown over the last few years in response to these large assessment increases. And then finally, that there have been recent and significant policy developments like the tangible exemption in the last few years, but that ultimately Rhode Island's property tax system has grown more out of balance, and that ultimately, I don't think I quite hammered this home enough, by falling out of balance, by pushing the tax burden particularly heavily onto commercial payers and onto non-resident homeowners, ultimately onto renters in a lot of communities, there is an impact to that, to the economy, to economic development, but also to housing affordability. So if ultimately it costs a lot more to run an apartment property, that is something that's going to be paid by renters. If it costs a lot more ultimately to erect a rental property, given the continuing cost of a large multi-unit dwelling, that's not going to aid in the state's crisis in terms of providing housing that people can afford. So we have a number of recommendations. I'm just going to read through them quickly to allow time for comments, questions. The first is that state policymakers should consider reforms to Rhode Island's education funding formula to better respond to these large disparities in property wealth. The second is that the state should maintain and strengthen the 4% levy cap, that it should ensure that it applies to all property tax revenues so that property tax revenues are evenly counted across cities and towns, and that state agencies have the appropriate measures to enforce the levy. The third is that the use of classification differences and homestead exemptions by cities and towns should be minimized, that the state should consider increasing the tangible personal property tax exemption, and cities and towns should work to streamline the reporting to reduce the administrative burden that we earlier described of the tangible tax, that policymakers should consider adopting separate tax rates on apartment buildings to allow for reduced tax rates on these properties, particularly given the large rise in their assessed value over the last few years, that policymakers should consider expanding or adopting mean-tested tax relief programs, especially for the elderly and disabled individuals. That kind of broad-based tax relief, like homestead exemptions, distort the entire system. But these more means-tested tax relief programs would enable cities and towns to better aid those that really are struggling with the large increase in the assessed value of their home, and not provide that aid to folks that ultimately don't need it, and thereby distort the tax system. And then finally, and we did not really get into fire districts here because they don't ultimately collect much in property tax. But what we found is that fire districts are not held to the same reporting requirements as cities and towns, that several had not even submitted their tax rate information in the last few years, and that's not good for municipal finance overall, that fire districts should have the same reporting requirements as cities and towns, and that state agencies should have the appropriate measures to enforce requirements. So thank you. The full report is here. We have a data dashboard in which you can manipulate a lot of the figures that I showed that have just kind of top 5, bottom 5 for all cities and towns, or our property tax rate comparison. We have the ability to click through several years as far as that goes, so that the data dashboard is kind of a fun piece. In addition, we have a monthly newsletter, and all of our new publications go to folks on our mailing list. You can sign up at ripec.org. And I'm happy to answer any questions or take any comments.
Great, thank you, Justine. For folks who do have questions, the reaction button at the bottom of your screen, there's a raise hand function there. or you can take yourself off mute and we'll call on you. Peter Schaefer, how did I know that you would be our first, our first person?
You know, I'm not sure. Is Randy still on? He was on. Chris is on in any event, so he can pass forward my remarks because we've had an email communication since.
I'm here too, Peter.
All right, good. You know, the one thing I got involved in last year, and we're going to go back to your report. What you've done a wonderful job of a historical summary, but the thing that's happened that we don't see the results of yet is elimination of the motor vehicle tax and some restrictions on the tangible tax. Now, the governor put in an appropriation act last year that removed indexing on the motor vehicle reimbursements. That was part of the promise that was made, and I was there when the promise was made. So that's why I speak up, because other people in the league, they're wonderful people, but they weren't there when the promise was made. And I communicated with some of the Warwick delegation and with other actors. The legislature put that language back in. So under the law, there's supposed to be indexing on the motor vehicle tax in the fiscal year 26 budget. And my only reason for speaking is that Randy, CJ, and David should think about communicating with the governor before he puts his budget in and remind the governor of the promise that was made when the motor vehicle tax was phased out. What you have here is a situation where all we have left is real estate. We have some tangibles, but there's restrictions on that. We no longer have the motor vehicles. That was a good growth area. I can see Larry Mancini nodding his head, and it's a bigger deal for Providence than it is for Warwick because their rates were so high. But it's a big deal for us too because we have all the airport cars. So that's my pitch, that the governor needs to be reminded. One, the burden has been transferred to the property tax. It's the only resource we have left on our main revenue stream, and that there was a promise made when the motor vehicle tax is phased out that would be indexing, and the language basically says you index it based upon the sales tax growth. That's my interpretation of it. So that's what I have to say today. You can go on to the next person, Jennifer.
No, I would note, Peter, that that's something that we noted and followed, and we were happy to see that the governor's language didn't go through. The only thing I would note for tangible, and I understand that that a lot of folks have tight budgets, and so it's not an insignificant portion of funds. But I would point out that the tangible exemption overall statewide, it decreases the levy by about 11-12%. I know that differs depending on community. It decreases the tangible levy, I apologize, by about 11-12%. And that's already a very small portion of the levy for most communities. And so while I think it's certainly a significant amount of money, and I understand that it's a significant amount of money in budgets across the state, I don't want to oversell how much money the tangible exemption went through. It's not, to the same level as motor vehicle, I don't believe.
Peter, don't worry, I put it on my list as we work through the budget. It is definitely on there. I appreciate it, sir.
Thank you, Randy.
Justine, if you don't mind, would you stop sharing your screen just so we can see
yes, I apologize.
faces too? No worries at all. Any other questions, comments? Michael, do you have any comments you'd like to leave us with today?
I was trying to raise my hand. So can everyone hear me? I hope they can. It's great to have such a great turnout. Justine, thank you for that presentation. Michael DBAs from RIPEC. We have, first of all, I want to say that RIPEC has the luxury of not having to deal with the political and financial issues that you have to deal with. So it's easy for us to say all the bad things about how the property tax system operates. And we also understand the political realities that the General Assembly is unlikely to put restrictions on cities and towns in terms of what they can do with respect to these differentials. So we've been exploring, and we're going to talk to some of the communities, particularly particularly some of the urban communities, exploring these different ideas. And I just want to raise the means testing, the idea that, for example, in a city like Providence, I know my good friend Larry Mancini's here, and there's others, I think Janess was on, that, that homestead exemption is very generous, and it's hard to change because there's a lot of homeowners of limited means in Providence. And maybe there's different ways, and we've, for example, a flat rate exemption instead of a percentage that you could take account. I know means testing can be hard, the administrative burden of income and taking tax bills, but thinking about some different approaches where we can actually respond to people without creating these imbalances that, in Providence, the non-resident rate is not as high as it used to be, and it's relatively high compared to other communities. But the commercial, part of the problem is that it's very hard to bring down that commercial rate because the homestead exemption is so broad. So I think, we at RIPEC are trying to explore some different ideas that perhaps would give communities a little more flexibility, because we understand that the financial and political considerations are really difficult.
Thank you, Michael. We'll give one more pass to see if anyone else has any comments. All right. Well, thank you everyone for attending today. I will upload our discussion to our YouTube channel, and we'll be able to share the slides as well with you folks. And thank you for attending today. And if anyone needs contact information, oh, I'm so sorry, John, please go right ahead.
I'm sorry to keep everybody. Just a couple of concerns for RIPEC. Some of the slides are a little bit jarring as far as the graphics, particularly the effective tax rate. I think the caution that I offer on that particular slide is that tangibles are taxed at 100%, and residential and commercial, the effective tax rate is reduced by the assessment ratio. So when you're taxing tangibles at 100%, tangibles gonna automatically be the high bar, and it's sort of a distorted picture against residential and commercial, which the effective tax rate, when you factor in the assessment ratio, is going to reduce the actual tax rate. So that slide gave me a little pause. I'm not sure how you factor in those of our communities that have heavy, what we call the 8% taxation, 44, 5, 13.11, because that reduces our taxes. So I don't know how that factors into some of your calculations when you have a municipality that's losing nearly $1 million a year in revenue because of the 8% rule. And then we got to start looking at some of the policies that are driving some of your slides, particularly the net assessed value slide that compared 2015 to 2023, where residential had a very large increase. What was the policy? Were there a lot of new constructions that were built? The tangibles went up, but also we had the policies with the green economy that all of a sudden solar became taxable in the tangible component. So there's some things that need to be filtered out to make some of the graphics a little realistic or more realistic. That's it.
All right, thank you. Okay, well, thank you so much again for attending, folks. I think we're just over time. And again, I will post this on the League's YouTube channel, and I'm sure Justine would be willing to send over the slides as well to share those out.
Thank you.
Have a great day. Thank you.
Thank you.